Good morning. Welcome to the investment meeting of the Teachers Retirement Board for June 1st, 2023. I will start by calling the roll. Kevin Lou.
Oh, here, representing Mayor Adams.
Thomas Brown.
Here, good morning, Patricia.
Dr. Angela Green.
Dr. Green here, present, representing PEP. Thank you.
Thank you. Allison Hirsch.
Present, representing Controller Brad Lander.
David Kazansky.
Present, happy Pride Month.
Victoria Lee.
Present.
We have a quorum. And I'll turn it over to the chair.
Good morning, thank you, Patricia. Good morning, everybody. We'll start with the Passport Fund's first quarter 2023 performance review. I guess we'll ask Roboton to do that.
Thanks, Tom.
Thanks.
Okay, this is an excerpt from the quarterly report, which was distributed ahead of time. Happy to address any questions, but I was just going to cover off as a reminder for everyone what the Passport Fund's performance essentially was for the quarter. We saw a fairly strong start to the year across equity markets, which resulted in positive results across the funds. You'll recall the Diversified Equity Fund was up over 7% in the first 3 months of 2023. We saw positive value add driven by active manager contributions in both developed and in US and non-US equity markets. And so that was certainly positive to the performance of the funds in the quarter. Across the other balanced funds, we also saw positive returns. The other Passport funds. The balanced fund had a return of just over 3.5%. The International Equity Fund was up just about 8% ahead of its benchmark. And we saw very strong results from the Sustainable Equity Fund in the first part of this year, with that fund up over 14%. And then beyond that, the two index funds offered as part of the Passport funds offering, both up over 6%, with the US outpacing non-US by just shy of 1%. So again, it was a very strong quarter in terms of both absolute market performance and relative results. Again, happy to address any questions in more detail if there are any. Otherwise, we'll move ahead to more recent news and go through the report for April.
Thank you. Any questions? Good. Move to the Passport Fund's April 2023 performance review.
Okay, I'm going
Thank you.
to pull that up as Amanda is beginning to present.
If you could just say your name before you talk. So I'm a new reporter doing the meeting. Thank you.
Amanda Janis.
Thank you.
So the month of April was a bit more subdued after a pretty active first quarter. So despite some of the ongoing concerns related to the banking sector, the month of April was largely positive across the board, although relatively small absolute returns. So looking across the Passport funds, all positive absolute results with the exception of the Sustainable Equity Fund, which was down about 70 basis points for the month of April. Although, as Mike mentioned, it had a very strong start to the year. So if you look out to the year-to-date period, the fund is still up 13.6% year-to-date. For the Diversified Equity Fund, which is where the bulk of the assets are for the Passport funds, for the month of April, up right around 1.2% and in line with that index. We did see a bit of underperformance from the active US equity component, although the active international equity managers did outperform, offsetting that underperformance from the US equity managers, and that has carried forward to the year-to-date period as well, where you can see the international equity composite up over 10% year-to-date through the end of April. In terms of some of the other options here, the Balanced Fund up about 75 basis points for the month of April and 4.3% year to date through the end of the month. And just slightly outperforming that balanced fund benchmark. And your in your index funds down towards the bottom of the page, we're tracking their benchmarks as we would expect for both the month of April and the year-to-date period. So I'll pause there and see if there's any questions on April.
Questions from Amanda? Thank you. So we're going to go now to May 2023 market performance update. Hi, or Devin,
Thank you.
give us some magic here.
Sure.
State your name for the quote reporter.
Thank you.
Devin Alexander for the record. So for the month of May, we did see sort of mixed to flat performance across the board. We saw that the global market composite benchmark was up by 0.3%, and the diversified equity funds up by almost 1%. The best performer for the period for the month of May was the Sustainable Equity Fund. But underlying funds were up by 4.76% and 4.99%. And sort of weakest performer for the month was the International Equity Benchmark, which was down by 2.46%. On a year-to-date calendar basis, we would like to address that, I guess, point out that we are starting to see some separation between the regions. If you want to look at the Russell 3000 index, you can see that it's up by 9.39% year to date versus the ex-US, which is only up by 6.2%. And even further down the page, emerging market index was only up by 2.52%. So again, we are starting to see some outpacing in the US market versus international markets. So the main takeaway for the month is that we are starting to monitor, continue to monitor market reaction to the debt ceiling agreement recently. Also monitoring any reemergencies of stresses in regional banks, and as always, inflationary and deflationary trends. Yeah. Any other questions?
Thank you, Devin. Any questions for Devin? Go ahead. Great. So we move on. Thank you, Devin. Thank you. So we're now at Fund Strategic Asset Allocation, also known as SAA, Capital Market Assumption Review. As we go to Paul's office, Steve.
Actually, I've asked Ed to give you a presentation. Chair Brown, also just sort of reflect that it's a 30-minute presentation, but because of the importance of the strategic asset allocation, wanted Ed to go first. If he runs long, I'll go shorter, so we'll make up some time at the back end. So we did swap.
Yeah, good morning, everyone. And before we jump into asset allocation, just to mention that for the benefit of time, we are skipping the regular risk update, but the materials are available on Convene. Broadly speaking, there are no big changes from the previous quarter. And if there are any questions, can take them now or later at any point. With this in mind, let's switch to asset allocation. Can we have the first page, please? Next page, thank you. So what you see on the screen is your current asset allocation. So it was approved by the board in 2018 and was implemented by them by around the end of the first quarter of 2019. So clearly there are three broad buckets: there's public equity, public fixed income, and alternatives. And broadly speaking, your portfolio, your asset allocation is similar to about the 60-40 classic portfolio, 60% equity, 40% fixed income. I think you have slightly higher weight to equity, 62.5. So just to remind you, the process of asset allocation, broadly speaking, goes through two distinct stages. In the first step, we'll formulate the capital market assumptions, which is really a projection for the next 10 years of the median expectation for the returns, for risks, and for probabilities. I'm sorry, for correlations of how asset classes interact with each other. On the second stage, we actually we're selecting the individual asset classes, we assign their weights, and it's done using a statistical technique. This is called mean variance optimization, to use a technical term. So today we're talking about the conclusion of the first step. Capital market assumption, arguably probably the most important step of the process. And obviously, nobody knows the future. It's unpredictable and unknowable. And yet here we are making the 10-year projections. And there's even no widely commonly accepted methodology here, because we're talking about the future. It's some blend of historical trends, mean reversion, and some holistic views on the economy, on the markets, and some future projections. And we are in a somewhat unique position for the benefit of seeing across 5 systems. I would say the unique feature for this presentation, we're stepping outside of the teacher's portfolio, looking across all 5 systems, which gives us a broad horizon, broad overview, and a good point of comparison. How your assumptions produced by Rakuten. I have Mike here on standby for any questions, I hope. And with the other voices.
So comment that obviously we've been working very close with Mike and his team, and the collaboration's been great. So this is more informational. So as you know, by contract, your general consultant is responsible for strategic asset allocation. So we've been working very closely. But because we have the purview of looking across the 5 plans and the assumptions of 5 general consultants, we thought it made sense to present that to the board. This is probably the most important decision that you'll make as trustees. So we want to make sure we give as much information, be as transparent around the process. So the idea that it's going to go through a series of wonderful slides that Ed's put together. But the idea isn't to browbeat any of the general consultants to have them change their views. As Ed said earlier, no one knows what the future is going to be. I do think that Rakuten Goldman Sachs has a unique approach. So I think we're talking about. So I invite Mike as well to interrupt that. I have a habit of interrupting it too often, but that's fine.
It's always a sorry. Now, just as Steve mentioned, Rakuten's approach is slightly different from the other systems. Where Rakuten, again, I'm not going to speak in depth, though, so defer all questions to Mike. But it's common across asset managers, consultants, to model individual asset classes, starting with the building, basic building blocks. I think where Rakuten is slightly different is to identify the main fundamental driving forces in the economy and the markets, so-called 9 factors, and model all assets from there. What you'll see later on, there's some difference, some minor differences, how Rakuten came across a lot of systems, but the end results are actually very similar and in line with other systems. But an important question to answer is, why are we talking about this today? Like, why is this urgency to asset allocation? And there are really 2 answers to this question. First of all, it's the markets. So obviously, when we're still going through a fairly extraordinary period of time with inflation, COVID, the ground war in Europe, and I think talking to all 5 systems or consultants, I think the message is that the majority of their clients, other pension funds, your peers, are going through the same exercise right now. So the time is right, and we'll be probably talking about it anyway. But of course, the pension systems within New York State have, as everybody knows, somewhat unique constraint, the basket clause, which was just relaxed from 25 to 35%. So these 2 reasons combined basically pushes us towards asset allocation. So just spend a couple of minutes on the basket clause. Can we have the next page, please? So it's an old legislation from the 1960s. And broadly speaking, basket clause has 3 types of assets. You can see them color-coded on the screen. So the green category, non-basket assets, which includes essentially the listed public equities and fixed income instruments domestically. There are no restrictions. And that's, of course, the US equity sleeve, the core fixed income, and the TIPS. The second category are the assets that we can hold up to 10%, but anything in the excess of 10% counts towards the basket clause. And you can see on the screen that, first of all, it's the foreign equities, which is still a combination of 2 sleeves: it's developed ex-US plus emerging markets. And currently, you're close to 20% utilization, which means that 9.8% counts towards the basket clause. High yield, being the domestic fixed income, is still restricted. But as you can see, we have plenty of capacity. So the basket clause legislation restrict to holdings over 10%. Current utilization 3.5. There's plenty of room for high yield. We'll be talking about representation. And finally, the alternatives, which is probably the biggest utilization of basket clause currently. And clearly, private equity, private credit is 100% counted towards the basket clause, and that's why we're restricted. And the real assets, which defined as infrastructure plus real estate, is exempt up 10%. So you can see currently there's no utilization basket clause, but we're cutting close to this limit. So the impact of this basket clause on your pension system, your pension fund, relative to the peers, there's some distortion. So first of all, the US equity allocation is probably higher than what it should be. And when I say higher than it should be, I'm really thinking about the MSCI equity, which is a broad measure of equities. So you have higher allocation to US equity, which actually worked quite nicely in the past because it was probably one of the best performing asset classes globally. And then on the alternative side, so on private equity, specifically private credit, that's where your allocation is lower than the peers, right? So it's probably more typical to see low double digits, maybe up to 20%. You have much less than that. So as now we have another 10% of basket clause, on the next step of the process, we'll be talking about the most efficient utilizations, probably a bit early to talk about at this stage, but we can touch upon it, some early indications as we'll go through the presentation. So the rest of the presentation is structured in three broad sections. So the first section will talk about the 2018 projections and how they stacked up against the realized performance, the realized outcome. The second section will take a look at the 2018 projections against the current vintage, the average across all 5 systems. And finally, probably the most interesting section, we'll look at the dispersion across the consultants. And we see some outliers of what it means for asset allocation. So with this in mind, let's dive into the first part. So let me just walk you through this page, a lot of charts. But they all structured the same way. So what you see at the top is the comparison of returns. The bottom row gives you the comparison of the risks or volatility. And what you see here, the gray bars is the average across 5 systems. The light orange bars shows the performance of corresponding market indices. So that's why we do apples to apples, because market assumptions formulated for broad market indices, not for the managers. And finally, the orange bar is the actual performance of the systems. Again, we're talking about the average, and that's where you see the impact of the manager selection. So jumping into, starting with chart number 1, which is the public equities, the 3 sleeves. The first thing that jumps at you is US large cap. An extraordinary performance of US equities. All of the assumptions were conservative, or US equities performed well and above expectations. And put in perspective, a long-term performance of US equities about 7.5%. So it's clearly extraordinary period. And the same to a large extent holds for developed ex-US, right? So the realized performance exceeded expectations.
Emerging arguments, but the assumptions are also, I'm sure Mike would jump in. They're 10-year assumptions, and it's over a much shorter time frame, for 3 or 4 years. So correct. They still, all those assumptions still may be correct.
We still have 6 years to go.
That wouldn't be positive for the path.
No.
Potential.
Well, that's a different story. Markets are markets. Right? What they do
Rather be
today-
wrong.
Yes. All want to have a realistic assessment, right? Unbiased assessment. On the risk side, you see how the assumptions lined up with the realized outcome quite nicely. And that's not surprising because generally speaking, the risk levels of volatilities tend to mean returns in the economy and the markets rather. The only interesting takeaway that the emerging markets were projected to be as a high risk asset, that's probably the perception of most people. That's not how it played out. And actually you can see that the risks in the emerging markets were actually slightly lower than United States. And that's really because of high exposure to the technology sector, which tends to be a high risk, high volatility. On the fixed income side, chart number 2, what you see is really an extraordinary period for a US core fixed income, and mostly US treasuries. And I forgot how many 100 years, it's a really unique period. But clearly the outcome was disappointing. We know why it is. Probably it will somewhat revert to the next 6 years. And much as it undershot on the performance, it overshot on risk. And again, we all know that the volatility of fixed income is a historically unprecedented currently. But the interesting thing that jumps at me at chart number 2, it's high yield. And I'll be coming to this time and again during this presentation. And what jumps to me is the predictable nature of this asset class. You see how well the realized return lined up against the assumptions, and also the risks, they came slightly lower, which is a good outcome. And finally, the last thing that kind of jumps at me from this page is the positive impact of your managers, right? We're talking about the orange bar versus light orange bar. Obviously, for US large cap, you don't expect much, given that the majority of it, like 80%, is indexed. But across all other assets, developed world ex-US, we see a positive contribution. Emerging markets, more than 10% outperformance. It's hard to complain about that. US core, large part of it comes from emerging performance. Again, a 1% outperformance in turbulent times, I see it as a positive. And finally, high yield, again.
That's active management.
Large part of it is active management, yes. And finally, high yield, again, your managers delivered 40 basis point outperformance, which is hugely positive, which is interesting. They delivered this outperformance while taking less risk, and that's unusual. Again, it's a positive outcome. So altogether, I say the results were good for the past 4 years. And the next page, can we go to the next page, please? The same exercise in private markets. I would say it's in line with public markets. So first of all, the assumptions, I'm looking at private equity, the gray bar. The assumptions included about the 3% premium for the illiquidity premium. And you can see the outcome reflects the illiquid nature of these markets. The results, public equity delivered a better outcome than US large cap, maybe not a proper comparative, but nevertheless. You can see it across all asset classes. Infrastructure, really positive performance. Private credit, comparable to high yield, about a 2% outperformance, as you would expect. Core real estate, really probably the most standout feature on this chart. You can see the core real estate delivered strong outperformance over non-core, which is probably hard to expect going forward. But again, positive performance for asset classes and for your managers. Just one word of caution, looking at the volatility at the bottom row of this page, you can see that the realized outcome significantly below the projections. And that's simply the nature of this asset class. So now there's certain volatility smoothing, since the asset is not marked to market, it's marked to model. So how do we deal with this in terms of projections and mean variance optimization? We usually think of volatility as a proxy for risk. We recognize that the observed volatility for private asset is not necessarily a proper measure of risk. So to compensate for it, all 5 systems, all 5 consultants tend to bring the volatility higher. Like how much higher, again, we'll see it in the third section. But that's why you see that the assumed volatility is significantly exceeding the realized outcome. It's a feature of the bug, and we'll see more of it going forward. So shifting towards the current vintage of assumptions, can we have the next page, please? So here we're looking at the change in the average assumptions across the systems. And again, the gray bars represent the assumptions from 2018. The black bars represent the average of the current vintage of 2023. And I would say the message here, it's about evolution, not revolution. Especially on the public equity side, you can see The numbers change slightly, probably in line with the observed performance. You can see that US large cap moves slightly higher, not dramatically. Developed world ex-US probably in line, in the emerging market, not a huge shift. Just to put these numbers in a historical perspective, if you look over long term, about 50 to 100 year performance, obviously US is a very longer period, other markets less. For US large cap, the long-term performance is 7.5%. So it's still slightly above these projections. Again, you just saw that in the past 4 years, the performance was extraordinary. So you can probably expect some mean reversions, not surprising. And on the emerging market side, the long-term performance was 6.8%. So the projected returns significantly higher. But again, I would say specifically for emerging markets, history is probably less of a guidance. Right? Just think about the role of China. Right? So 50 years ago, China was a footnote. Currently, China is number 2 economy and one of the main contributors to our economy. So I would say in emerging markets, history is less of a guide. And on the fixed income, clearly the projections reflect the recent repricing of fixed income. The yields move significantly higher, be it on the treasuries or corporate side. So you can see US core, the projected returns move from 3.4 to 4.4. The 50-year return for the core domestic core fixed income is 6.6%. But again, need to put in perspective, the interest rates at the end of the 80s stood over 20%. They declined to almost negative level before the pandemic. Mathematically, it's hard to expect the same fixed income rally from the current level of 5-6%. Would be hard to deal with 20% full market. So it's completely understandable the pricing on the return side, and also on the risk side. Obviously, the risks move slightly higher, consistent with the current market environment. Again, I'd like to single out high yield. The returns move slightly higher. The risk assumptions stayed about the same. And again, I go back to my message of somewhat predictable nature of this asset class. Moving on towards alternatives. Can we get the next page, please? The same message. It's evolution, not revolution. You see that returns move slightly high in line with public markets. No huge surprises on the private equity or private infrastructure side. We'll show hedge funds here, but it's here just a point of preference. Clearly, your portfolio is no allocation to hedge funds. And on the right hand side of the page, you can see that private credit again preserves the same about 2% illiquidity premium versus public markets. Core real estate, the expectation was slightly higher, again in line with the extraordinary performance. Non-core is about the same. There are no huge takeaways here, and it's not a bad thing. All right, so with this in mind, I think let's move towards we'll see a more interesting section. Can we have the next page? We will look at the dispersion across the 5 systems. And we start with the fundamental building blocks, like the macro assumptions, and that's the inflation, cash, and treasury assumptions. And of course, inflation is the biggest wild card, right? So we obviously going through a very extraordinary period of time. It's hard to tell how to play out the different projections. We all have our personal opinions, but the truth is nobody knows. So with this in mind, it's interesting to see, if you look at chart number 1, that all 5 systems are in broad agreement on the future of inflation. So you can see it's pegged around 2.5%. It's probably not that surprising, given, first of all, that's not far from the stated target for the Federal Reserve of 2%. And also the inputs for these projections were broadly similar. It's the dot plot published by the Federal Reserve, and also the shape of the forward of the Fed Fund futures. So again, no huge takeaway, broad agreement. Where you see more dispersion, the chart number 2, cash assumptions. And kind of put in perspective, historically, the cash returns tend to run slightly below inflation. But obviously, the big question, the elephant in the room, is the path towards disinflation. And where you see the difference in projected returns, it's how we transition from this high inflation environment to the normal environment in 10 years. And you can see, for example, Callum, it's like came out at the low end at 2.8% assumption, and that's because they assume a faster path of disinflation. So they assume inflation coming down fast and stay low. On the other side of the spectrum, you see Wilshire and NEPC at 4%. It's the opposite. They assume that inflation stay elevated for a longer period of time, and then comes down to the same level. So they assumed returns are much higher. Rakuten again, was Mike in the room. Maybe on the lower end, but probably closer to the average. Again, there's no huge disagreement. But I single out this chart, the cash returns, because cash is really the most fundamental building block. It goes into building assumptions for other asset classes. And later when we talk about Sharpe ratio, that will be a key input into understanding Sharpe ratio. And finally, chart number 3, US Treasuries. To be honest, given chart number 2, cash returns, I expected more dispersion. That's not really so. You see that all systems in broad agreement. Again, this is more about the shape of the yield curve, which is observable, about the forward market observable. Given similar inputs, it's not surprising that the assumptions are similar. So again, not a takeaway, not necessarily that thing. So let's dive into individual asset classes. Can we have the next page, please? Thank you. So starting with public equities, so we'll look at all 3 sleeves. And first of all, chart number 1, US equities. And that's really the most important building block for your portfolio. So you have a 27% allocation to US large cap. Maybe it will come down slightly with the change to the basket clause. But it's interesting to see how broad range the consultants put on this asset class. Right, so the returns, again, Rakuten came probably right in the middle of the range. But you can see the assumption range from 5.4, from the low 5.4 to the high 7.7. It's a broad range. On the risk side, the volatility, chart number 2, there's more of agreement, which is not surprising because volatility tends to mean revert over the time. And that's where you see a bit of a difference for where Rakuten comes slightly lower versus the other systems. And the same message runs across all 3 equity sleeves. So what's important when you make this comparison, it's not really looking at US equities Rakuten versus the rest and asset class by asset class. What's important here for asset allocation is to see the consistency within each consultant, right? You can see the same theme run, the same theme runs for all asset classes. Rakuten comes slightly lower on risk. So on a relative basis, this consistency to make expect a similar outcome for asset allocation. Probably the only difference here you can see on the emerging market side is more dispersion, which again, not really that surprising to me, given that this asset class underwent a lot of changes. Again, it's the role of China and the input of China on the returns. So, and obviously China now is in a very peculiar, the economy of China in a peculiar state. I would say it's probably one of the biggest transitions for the next 5 to 10 years that will affect global markets, global economy. So it's not surprising to see more of a disagreement. But again, the broad picture is very similar. Any questions? Okay, so moving towards fixed income. Thank you. Again, probably similar messaging. You can see that Rakuten came somewhere close to the middle of the range. US keeps probably the asset class with the smallest dispersion, which probably somewhat surprising given that certainty around inflation. And probably the only chart, the only asset class to kind of pause on this page is high yield. The chart number 3 for performance and number 6 for risks. And first of all, obviously, the assumed returns are higher than for other asset classes, not surprising. That's where Rakuten comes probably at the lower end of the range. But also you see that both the returns and risk assumptions come lower, which is consistent, right? So in terms of asset allocation, we'll see later with the Sharpe ratio. It's not really as much was an outlier as it seems to be from this page. And moving on to the privates, the alternatives. First of all, private equity. Obviously, it's an interesting asset class. And when I say interesting, we do not really have that much of history, right? Obviously, we have more than 100 years for public US equities. Private equity really came on its own really after the global financial crisis. So it's probably obviously strategy exists long before that. But the scale and the penetration of private equity really should be after 2008. So we don't really have that much of history to fall upon. But you can see that broadly speaking, all consultants target roughly about 9.7%, right? So it's about a 3% liquidity premium. Rockdown came slightly higher on the return assumptions. What's probably more important on the risk, on the volatility assumption, you can see that Rockdown slightly below. So what it means when we go through asset allocation, the optimizer will naturally favor private equity slightly more, right? So you may expect slightly higher private equity allocation. The same true about private infrastructure. Yeah, no huge takeaway. And again, hedge funds here, just as a point of comparison, clearly you do not have current allocation to hedge funds.
Yeah, has a question.
Yeah, I'm Dr. Green.
What's your, just say your name, sorry.
Tony Giordano. Dr. Green is sitting, but I just had an information question. In terms of volatility in private markets, how is that calculated? I mean, it's pretty easy to understand in public markets. How you're calculating price volatility? Is it the assumption that's given, the markup, and what's realized ultimately? How does that work? Just from an information standpoint.
I'll give you one comment before I bounce it to Mike. So we had a number of interesting discussions when we brought specialist consultants with the general consultants. And I think there was more alignment in terms of returns.
Okay.
Even though you'll see on the next page, specialists see it a little bit more optimistic. On the risk side, specialists tend to think in terms of observed volatility. But then you keep in mind that specialists do not have the asset allocation responsibility. So they see on the asset class in isolation, where I would say all 5 general consultants saw it in slightly different terms. With this in mind, I'll pass it to Mike to talk about specific methodology of Rockdown.
Yeah, so our numbers are definitely a little bit of an outlier, right? At just over 21% from a volatility standpoint, but we are thinking about it more in terms of, I think like the other consultants are a little higher, thinking of it more along the lines of if you were actually marking all of those assets to sort of the same changes or fluctuations, if you will, in public markets, maybe just not to the same extent around the same considerations more broadly as it relates to leverage and to just sort of the fees and carry that get incorporated in our assumptions more broadly for public markets, for private markets. But when we think about our private market assumptions in general, I think what we've found, which has led to us being a bit of an outlier, is rather than just assuming in our private equity modeling that you're going out and you're getting sort of the average return across all offerings in the private equity marketplace, we're actually making the assumption that if you're going to take the decision or make the decision to invest in private equity, you're probably applying a pretty rigorous process to identifying those GPs that tend to outperform. You're not going to do that, by the way. We would say don't invest in private equity. And so rather than just ascribing sort of an average level of return and volatility, we are saying that you're going to get compensated a little bit better for applying that rigorous process and achieving more of like the 40th percentile outcome, for example. And so you're being better compensated for that tracking error. We're not implying the same amount of mark-to-market volatility that the other consultants are.
I've never seen volatility expressed in this way. I like it. I'm just curious about, the
Yeah.
process of how it gets done and what's what kind of time frame do you use? Is it a quarterly time frame or is it done based on, again, when you, event driven, when it's coming to fruition?
Actually, if I hear the question correctly, you're asking how so it's mark to model. It's not necessarily mark to market. You're right. We don't have the observable outcomes on a quarterly basis, and it's usually done with a 1 quarter lag.
It's good stuff. It's good stuff. I'm just
Yeah, but just-
interested in
but on top-
how the sausage is made. So,
When we kind of think about volatility in private assets, so fundamentally, it's still equity. Right, so they clearly, it's a different investment process, how private equity works with the portfolio companies. But over the long term, there needs to be some degree of convergence between public-private markets. And it's also an element of leverage embedded in private equity. So the common approach to establish volatility for private assets, you start with public markets, you apply some leverage, you apply some adjustments for a different process. So if public markets run in about 15 to 20% range volatility, you may expect volatility for private equity, given its levered nature of the asset class, to be between 20 to 25%. And that's exactly where you see.
I would say that the fact that our expected volatility for private equity is a standout to the lower end is consistent with the fact that our public equity volatility is also a little bit skewed to the lower end. And again, we're applying that leverage factor to it. So it's not surprising that we consistently are shifted a little bit volatility.
it makes sense. Thank you.
What I think is unique about Rokutan's approach is Mike just described, they look at the top 40 percentile in private equity and assuming we can, obviously we've got shown strong capabilities around investment manager selection within the Bureau of Asset Management, but we also leverage your size, the collective size of the 5 plans. Teachers was big enough on its own to get better access, better economics. So we go through that process of because of the size, we get size discounts and we negotiate down the fees. Also, Nath and his team do a number of things around co-investments as well that are typically no carry, no fee that really average down the expenses.
Yeah, the last thing I'll add is that private equity is one of the few asset classes where we do tend to see persistence in the value add that active managers can add, whereas on the public side, it's very challenging to find that.
Okay, so we'll already touch upon the next page, but let's just finish this. Just finish discussion. Perhaps you have the next page, please. So here we bring the assumptions of the specialists. And just to mention before, it's probably not a huge surprise to anyone that generally speaking, specialists see the returns in the more optimistic terms. They're materially higher, and they see the risks as materially lower. So there's not much to decide about it. It's we discussed, I think, a lot about it.
But in those volatility numbers, actually those are observed volatilities as opposed to adjusted.
It varies. You can see at the bottom of the page, like Hampton Lane makes an adjustment, brings the public market to the equation. They still come at the lower end. Stepstone is using just the observed volatility, and you can clearly see how much lower it is. So 10.7% is significantly lower than public markets.
I like Hamilton Lane's optimism.
They guarantee it though.
Again, that's well, the question of what the risks are, that's a different story. Okay, and just to finish with the second set of alternatives, can we have the next page, please? Thank you. So private credit, again, the same theme as I keep mentioning about high yield. Obviously, it's the private equivalent. Fairly small amount of dispersion. All consultants obviously assume a premium, a liquidity premium for the asset class. Core real estate is where you see probably more dispersion. And yeah, it's not surprising. We just talked before how extraordinary the performance was of core fixed income. Probably reasonable to expect some degree of mean reversion going forward. How much, nobody knows. So you see some dispersion. The only standout is NAPC, but yeah, it's not for us to discuss today. And finally, the same exercise, okay, the next page. When we bring the specialists into the picture. The same messaging, the return assumptions are materially higher. Maybe not as much as for private equity, and the risk assumptions are materially lower. Again, no huge surprise. So the next page, just to wrap up this discussion, I want to spend some time talking about Sharpe ratios. Okay, the next page, please. And the Sharpe ratio, of course, is just the ratio of excess returns over volatility. The reason we talk about Sharpe ratio because it gives an indication of how optimized and may sort out the asset classes. So it's probably wrong to assume that the high Sharpe ratio is the best asset class. That's not always so. First of all, we need to think about the correlation between asset classes. And we also need to keep in mind that we talk about the volatility as a measure of risk. It's definitely a measure, it's not the measure. Risk is significantly more multidimensional, it's more complex, and it's something we need to bring into the asset allocation discussion. That's it gives you a good idea of how asset classes stack across each other. The other kind of number to keep in mind before we dive into the numbers is the long-term Sharpe ratio for the asset classes. And if you look at the US large cap, and that's what we have called the most historical track record. So over a long time, US large cap has a Sharpe ratio of 0.37, which simply means that for every 1% of volatility, you realize about 37% of excess return. Maybe somewhat surprising is that actually all asset classes have the same Sharpe ratio over a long time. So all asset classes tend to converge about Sharpe ratio of 0.37, give or take. So it's a useful number to kind of keep in mind, in the back of your mind, as we go over these numbers to kind of level sets the rest of the numbers. So let's just dive straight into it. Starting with the equities, public equities is the top row. So first of all, let's look at the US large cap. So you can see that the average Sharpe ratio across 5 systems 0.19. It's far below the historical average of 0.37. And that's again simply a reflection of fairly extraordinary performance delivered by US equities in the past several decades. You can see that several outliers, a strong dispersion here. But again, Rockatan comes, let's say, in the middle of the range. Again, so we talked before that Rockatan may be a bit of an outlier in terms of returns and risk assumptions, but when we bring it all together, and as I mentioned before, despite the different methodologies, it shakes out about the same, right? You can see that for US large cap, for developed world ex-US, for emerging market equities, Rockatan comes very close to the middle of the range. US tips, chart number 4, is an interesting asset class. Like if you recall a few minutes ago, I mentioned how little dispersion there was for US for the tips. The return assumptions and the risk assumptions were very similar across 5 systems. Yet here we are, and we see the largest dispersion across for any asset class. And the answer simply is the cash assumptions. Because remember, Sharpe ratios formulate in terms of excess return, excess over cash. And you can see between the Callan's 0.24 to the Wilshire almost negative. This is a high dispersion, but again, Rockatan is somewhere in the middle. And finally, I'll skip US core fixed income. Again, there's no huge takeaway for Rockatan, close in the middle of the range. High yield, again, going with my theme of how predictable this asset class is, you can see it's probably the least amount of dispersion across 5 systems. So the Sharpe ratio tends to be on the high end. It's the high Sharpe ratio on this page, 0.26. And I would say all 5 systems are in broad agreement. Again, Rockatan is close to the middle of the range. Alternatives, the next page. The thing that jumps at everyone probably these orange bars, right? The assumption of specialists. And I wish I could promise you a Sharpe ratio of 1. First, I'm a little skeptical. I will probably go more with general consultants. And again, we saw a lot of dispersion, but once you put it all together, things become to be more similar, right? If anything, just as Mike mentioned before, Rakuten is somewhat unusual to bring the manager selection to the process, so the sharp is like it's on the high end. We're not talking about huge deviations here. It's reasonable and easy to understand. So I'll stop here. Just one more point I want to mention. So we talked about the returns and the risks. This is actually the third component, the correlations. There are tables in the appendix. We'll be happy to answer questions over them. Much like with the returns and the risks, there's some dispersion correlation assumptions, which is not surprising. It will all come together next stage. So we'll start talking about the asset allocation. And hopefully around September, October, we'll have an update in the same fashion. So I'll stop here for any questions.
Questions?
And I've got a quick one.
Who's talking? Sorry.
Oh, sorry, Dave Kazansky. We can go back, I think it's 2 slides to the sharp form tips. I just want to, I understand different opinions. Why is Wilshire so down on tips? I mean, their expectation regarding inflation is lower than others, but not substantially. So why is there a version of
It's not
we're going to
really,
get on sharp
yeah,
tips so vastly different?
it's really not so much about tips, about cash. So if I go back to page number 8, you will see chart number 2 gives you the assumptions for cash. And I mentioned before that that's where we see the most of dispersion.
Right.
So in the numerator for Sharpe ratio, you have the S plus return minus cash returns. You can see that for Wilshire, cash assumption was 4%, very similar to tips. So you have 0 in the numerator and the results are predictable.
Thank you.
It's not about tips, it's about cash.
Thank you. Any questions? Great, okay. Steve?
Thanks. Next presentation. So I'm glad we actually allocate a little bit more time for the strategic asset allocation review, which went about 45 minutes. I'm going to give you more of a Reader's Digest update on just the markets and what we're seeing. I know Mike, Amanda, and Devin have already done a good job talking about the end of the year, the first quarter, and then more recently, but kind of walking through where we are. Hey, can you bring up the slides?
Bringing them up right now.
Thanks, Kate. So just as a general matter, as the slides are being brought up, inflation continues to still be a challenge both here and abroad. Although directionally we moved down quite significantly in the US from a peak of 9.1% inflation in June of last year. We're just about 5% now. We had a good surprise in Europe today with a lower inflation number at 6.1%. And the UK still is a little on the high side. What we see on slide 3, Kate, please. You can see that, again, that's just an example where we are at 4.93% CPI. More importantly, though, you look at the core PCE deflator, which is the Fed's preferred measure of inflation, been pretty sticky for the last year, just under 5%. And that leads me to believe that the Fed's probably going to on hold or keep rates high for a longer period of time than had been expected and priced into the market. On the next slide, similar with the core CPI, you can see it's sticky there around 5%, both year over year and 3 and 6 months. So a little bit more of a challenge for the Fed, I think, going forward. On the next slide, around the world, we see, as I said, inflation moving down, directly correct, with one little hiccup in the UK on the far upper right-hand side of that slide. You can see that gray bar. Inflation actually ticked higher from 10.1 to 10.3. Now it's back down to 10.1% in the UK. So still a lot more work to be. Yeah, it's still over 10%. So a little more challenge there. Employment on the next slide. Employment in the US has actually been quite robust. We had 253,000 jobs created in April. We are still at a 53-year low in the unemployment rate of just 3.4%. ADP numbers came out today. There were 100,000 above consensus estimates. We get non-farm payrolls for May tomorrow. And the expectation is that we'll see 195,000 jobs created. and the unemployment rate perhaps tick up a little bit to 3.5%, but still very low. And in terms of what the Fed's trying to achieve, a little bit of a headwind for the Fed. On the next slide, just another look at that. From a chart, you can see that the participation rate is actually moved up nicely. It's still not close to where it was pre-pandemic or certainly in 2019. But again, more people are actually coming into the labor force, which is helping. On the next slide, again, still we see the levels of the participation rate below 2019. A little different slide. On the next slide, it's a look at what the market's expecting, what individuals are expecting in terms of the unemployment change associated with the soft landing. So towards the middle of that slide, you can see there's an example of crash landings at the outset of the pandemic, 2020, 2008, 2009, where there was a dramatic increase in unemployment. Typically, when we go into a recession, you see employment on average will go up a minimum of 2%. The consensus estimate for 2023 right now is for there to be a moderate increase in inflation and a moderate decrease in real GDP. And that's the green, the dark blue is the nominal GDP, and the unemployment rate is on the far right-hand side. So that's what the market's currently looking for. And we'll see how that pans out over the coming months and quarters. On the next slide, let's look at economic growth. Economic growth in the States is actually picked up a little bit. We've seen a resilient consumer, even housing's shown some strength recently. And you couple that with a very strong employment market, and we had a 1.3% GDP print for the revised up from 1.1% for the first quarter this year. More importantly, and Ed talked about on the lower left-hand side, you can see the reflection of China. The reopening expectations for China couldn't have been higher, and the expectation was for 5.5% to 6% growth. China is actually targeted at 5.5%, and they're coming in slightly below 5% at this point. So a little bit more of a headwind in China, which hasn't been an economic engine for growth. And Europe was hoping to benefit from that. So you've seen some sell-off in European equity prices as a result of these numbers more recently. Next slide. I don't know if you've got great eyes, but on the right-hand side, you can see where we were pre-pandemic, pandemic, and more recently. And again, that's just a reflection that the dark blue and the light blue lines are China and US GDP growth. China, again, just under 5%, and US just over 1%. On the next slide, something a little different, just a return to work and show where we are in that process. I know that people have become quite accustomed to working remotely, which I think has been a good accommodation for many people. But we continue to move back into the office at varying paces around the country. And you can see those are some of the largest cities. New York City is about in the middle of that mess on the right-hand side. Another slide looking at the return to work, it looks like the ridership of the San Francisco BART system, their tube system, and the the New York subway system. You can see that the New York ridership has actually gotten up to about 70% of where it was using a baseline of 2019. A little more sluggish of a return in San Francisco. Next slide. Probably near and dear to at least to my heart is rentals are still very expensive in Manhattan at near record high. Seems to be probably good for the economy here. Yeah. Next page. Yeah. Next slide. This is actually a look at expected economic growth, and you can see that the market is expecting or investing. Sorry, this is an equity investor. This is the earnings per share growth. It's expected to be somewhat subdued and negative. So an earnings recession in 2023, which we're still not seeing at this point, although we've seen marks down, but outperformance relative to those lower expectations. On the next slide, a look at interest rates. The Fed is either near or perhaps at a pause. Many people are not talking. I've heard the words this morning about a skip. They've had 10 consecutive interest rate hikes in 2022 and 2023. They meet again on the 13th and 14th of June. And the expectation is they probably will take a pause, but I think it's very data dependent. We'll see what the employment numbers look like tomorrow and inflation looks like before they have their meeting on the 14th. On the next slide, just a look at where we are in terms of financial conditions and rates. On the far right-hand side, you can see that's evidence of the dramatic 10 consecutive interest rate hikes here in the States, equal to 500 basis points. But the starting point was a range of 0 to 25 basis points. And on the bottom chart, look at Goldman Sachs Financial Condition Index, which has improved somewhat, but still languishing below where it had been pre-pandemic. Another look on the next slide is at the extent and of the recent hikes. Again, on the right, you can see 500 basis points in increases over a relatively short period of less than a year. In terms of the day count below, it's actually over a year now. It's about 14 months. So that scale's not right, but just an example of how dramatic and how aggressive the Fed's been. Rates where they sit today are at a 16-year high. Again, hadn't been this high since before the global financial crisis. Maybe skip ahead 2 slides to U.S. credit spreads and treasury yields. Thanks, Kate. So in fixed income land, we see U.S. treasury yields have moved higher. The market more recently has been pricing out the expectations for rate cuts this year. Some of that has to do with the robustness of the economy and the resiliency of the economy. Also, Fed speak, managing expectations around being higher for longer. Today, we've got 2-year treasury yields pricing at 4.45 versus 10s at 3.65. And we see credit spreads have been wider. They're about 100 basis points wider for high yield than they were, say, pre-market sell-off last year. On the next slide, just a little noteworthy on the upper left-hand side of the left-hand side chart, you can see a little bump up top. That's just the red line. It's very hard to see, but it's just an example that 4-week treasury bills were trading at a premium to everything else, given concerns about the debt ceiling. And given the good news we've had and the progress we've had in terms of resolving that issue in Washington, that's kind of come off and out of the market. On the right-hand side, you can see that the Treasury 2-year and 10-year Treasury spreads have narrowed a bit. They were at a wide of over 110 basis points earlier this year. They're now in about 80 basis points. This reflects 71, but again, there's been a lot more volatility in fixed income than there has been in equity recently, and that's evidenced on that slide. Let me skip ahead, Kate, just for the sake of expediency. Look at credit spreads on slide 23. As I said, spreads have widened. They're a little over 100 basis points according to this chart. High yield at 4.84 and investment grade credit at 1.46. Actually, this morning they're at 1.38 investment grade and just 4.60 for high yield. So credit spreads bouncing around a little bit, given expectations of the potential for a Fed pause and the good news of coming out of Washington recently. Skip ahead a couple of slides to the U.S. dollar slide, Kate, slide 25. The dollar's weakened in the early part of the year and strengthened more recently. That has to do with the fact that the U.S. economy has been more resilient than those in Europe and the UK. I don't know if you read, but recently Germany moved into a technical recession, and the U.S. continues to see relatively robust growth on a relative basis relative to the amount of tightening that's been done for the first part of the year. Okay, maybe move ahead to the U.S. stock and bond market returns, which is really so give me a little bit of a backdrop of where we are economically, and now let's talk about what we're really seeing in the markets. Investors have been buying fixed income given higher yields and credit spreads. We also see that the debt ceiling has been resolved, but the lower left-hand side headline there, don't expect markets to rejoice if a deal is reached in the debt ceiling. So we've actually gone into what the Treasury refers to as extraordinary measures beginning in January when we hit the $31.4 trillion debt ceiling. As a result of that, they've actually worked down their balance. So typically, the Treasury's general account at the Federal Reserve Bank is about $600 to $700 billion in size. It's a little under $40 billion today. So what will happen is once they suspend the debt ceiling, the Treasury has a lot of issuance to do, upwards of $1 trillion worth of issuance, mostly in T-bills through the end of the third quarter, through the end of September. And that has a tendency to, a potential to distort markets. So driving treasury yields higher, T-bill yields up dramatically, the cost of leverage financing for hedge funds up, which can create challenges for credit spread product as well as equities. It's also going to increase the amount of money potentially that banks have to pay for deposits. And I've got an interesting slide on that in a couple slides. On the next slide, let's look at year-to-date equity returns. And you can see on the far right-hand side, there's a lot of green in the screen. The NASDAQ up, so 2 days ago, up almost 25% year-to-date. Obviously, tech has done well. That's really an AI story. And it's very concentrated among a very small handful of companies. So it's not an even and balanced and broad-based rally. I'd say more importantly is if you look at the middle of that screen under EMEA, those are the European markets. They've all actually performed quite nicely, coming up with challenging 2022. And a lot of this had to do with expectations around China's growth and the exporting to China, which has panned out to some extent, but not to the extent that.
What is the difference between the last columns? Is that year?
Yeah, well, it's year to date and it's year to date in the currency. So in the US, they're identical, right?
Oh, I see.
Year to date in currency for the top three. And in Europe, it's in euro denominated for the most part.
I see,
Yeah,
I see, I see.
That's a great question. So if you look at the FTSE, year to date, it's only up about 94 basis points. But because the currency had appreciated relative to the dollar, it's at 3.52, 3.52% return. Although the dollar has actually strengthened relative to the pound sterling recently. On the next slide, look at bond markets. Year-to-date changes in yields. These are 10-year sovereigns. On the right-hand side, you can see the U.S. Treasury 10 years is down, moved down in yield by 18 basis points. I'd say the biggest takeaway there is that almost all manner of sovereign 10-year debt is lower in yield, higher in price, with the one exception being the UK, given the stubbornness of inflation there, the fact that there are more rate hikes to come, that yield has actually moved up 58 basis points. On the next slide, so look at volatility. On the left-hand side, you can see equity market volatility measured by the VIX. It's been fairly subdued, in fact, surprisingly so, given concerns around the potential for a bad outcome with the debt ceiling. More importantly, on the far right-hand side of that right-hand chart, you can see that the volatility in U.S. Treasuries has persisted as measured by the MOVE index. Let me jump ahead 2 slides. This is actually a look at year-to-date performance, where it's a 10-year slide, but more importantly, we're focused on large cap versus small cap. Small cap measured by the Russell 2000 in red has actually really kind of moved sideways to down a little bit. More importantly, the Russell 1000, which is an index of large cap stocks in green, is actually had quite strong performance. Again, that's not a broad-based rally that's highly concentrated among a small number of companies, but a fairly good outcome nonetheless. Maybe skip ahead 2 slides to recent news, Kate. And I did want to talk about some of the challenges we've seen in regional banks. And I'd say the regional bank disruption right now is relatively calm. I do think the conditions persist in terms of higher rates and embedded losses in their loan portfolios, treasury holdings, and mortgage loans in particular. And as rates move higher, there's more competition for the banks to have to pay up to secure deposits. Right now, you can invest in treasury bills over 5% short, versus the average basis point return for bank deposits is about 45 basis points. So that interest rate differential is driving a lot of investors to move out of their banks and into money market mutual funds as well as treasury bills. Maybe move ahead, actually 2 slides, Kate, and this is just an example of what I was talking about. You can see how dramatically higher Fed funds target rate is on the far right-hand side in green. The 2 lines that really converge at the bottom, the yellow and the blue, actually the national average interest rate for savings accounts and the national average interest rate for checking accounts. And again, it's on this slide, it actually reflects below 0.5%. And again, that's the challenges that some of the banks have right now, is they've got these embedded losses within their portfolios. And they need to pay up for deposits as money moves out of bank deposits and into money market mutual funds, and treasury bills for significant yield increase to pick up. I do think that the banking system, although it's calm now, I think it still has the potential to come under more pressure because the conditions that were evident in March, April, and early May continue to persist and perhaps get worse with the amount of treasury bill issues that we're about to see. Maybe move to performance now. Kate, if you can pull ahead of a couple slides. On 39, the public market returns for the calendar year. First quarter, you can see in the middle of the page, it's all green, which is nice to see. Although that hasn't really persisted necessarily through the second quarter. But it's just an evidence of a recovery in asset prices in the public markets for the first quarter of the year. On the next slide is a look at the teachers' retirement system net public market returns. Those are percentages for 3 months. So for example, on the top, US equities returned 7.4% for that 1 quarter. And you can see it's green across the board. Still challenged in the 1 year space because of this dramatic sell-off we saw in 2022. But again, it's good to see that there's been improvement in asset prices in the public side anyway. And I think certainly as a long-term investor, you're more inclined to focus on 5 years returns or longer. So on the far right-hand side, you can see that it's mostly in all green, exception of emerging markets, equities. So a pretty good outcome. On the next slide, I'll look at net private markets by manager. You can see the 1 year returns in percentages. For 1 year, private equity has delivered a negative 3.8% return. You can see that the other returns are positive in core, non-core real estate, infrastructure, and private credit or opportunities of fixed income. More importantly, on the bottom of that page, you can see the aggregate performance for the teachers' retirement systems plan. It's up 4.8%. It's right on top of where policy returns are, 4.8%. Still negative in the 1 year space, but positive 3 and 5 years. Good development. I think the other takeaway from the bottom part of this slide is the public market equivalent is 65-35 portfolio that would look at a mix of public stocks and bonds is up 6%. But we have exposure to private markets that are marked with a lag. So that's detracting a little bit from performance very recently. And that's what we see on the screen. On the next slide, this is a quick example of the consistency. We're right on top of where the policy returns are, 4.8%. And on the following slide, I'll look at the public market excess returns in basis points. And what I think you'll find striking is they're all positive, they're all green, and some are quite positive for the 3 month section of the excess return. But overall, the portfolio is still delivered a negative 8 basis points relative to the policy benchmark. The 4.8 before was around, this is 8 basis points, so rounded down. So it looks like it's equivalent, but there's a little bit of a drag. Most of that's due to the private asset markets, which are through December 31st. So still a good outcome, I think, over time. On the next slide, we look at the excess returns in 1 year for the private assets. So still, notwithstanding my comments earlier about the potential drag on performance of private equities delivered relative to its benchmark of the Russell 3000 for the full year, it's still up 1,452 basis points. So again, strong outperformance relative to that public market broad benchmark of Russell 3000. On the next slide, just a look at the summary of the rebalancing activities we've done for the first quarter. Again, here we're really rebalancing to raise cash to meet benefit payments and capital calls. You can see that on the far right-hand side, raising $340 million. And John Mercerberg has gone through a process of rebalancing large cap and large and mid cap equities and investing in the emerging manager program, the international fund of funds. You can see that's evidenced by the 225 investment on the far right-hand side. And with that, I'll open up to any questions.
Any questions for Steve? Thank you, Steve. So move on to Black Is BlackRock in the house?
Okay, Ron?
They're due at 11:30, is that correct, Ron?
Ron's not here.
I want to go find.
Ron
Do it at
11:30.
Might have stepped out there. I'm not sure if he stepped out again.
Oh, he may.
Guys, I have more slides I can go through. Kidding.
How about a break?
Yeah, break, 7-minute break. Why don't we take a break? So it's 11:24 now. We'll be back by, let's say, 11:35.
In the meantime, I'll check on their ETA, so if they move things around, we'll do that.
Okay, so we'll take a break. Thank you. Order of the agenda, since BlackRock is not here yet. And what we'll do is we'll go out of public and into executive to do Westwood. And then if BlackRock is back, we'll go back into public. How does that sound? So there a motion to go into executive session? So moved. Is there a second?
Second.
Any discussion? All those in favor say aye. Aye. Anthony's not here. Oh,
He's getting coffee.
I should have waited, actually.
I'm Angela Green.
Dr. Green is.
Yes, I'm here.
Okay, thank you.
Yes.
All those in favor, say aye. Aye. All those opposed, say nay. We are in executive session. Liz,
I'm here with Jessica Tan. Jessica is the head of Sustainable and Transition Solutions.
I'm sorry, this is Janet. I just want to interrupt. So I think that the Stone Group was admitted into this meeting erroneously.
We're in public session, Janet.
I
So-
see. So everybody needs to,
They can get off themselves, but I don't think we can. kick
yeah,
anybody
I
out.
see. Okay, apologies. Like,
you want
folks. Yeah, can you just exit the meeting? Sorry about that.
That's okay. We'll drop and redial in. Thanks, guys.
thank you, Janet. Thank you. Okay, I'm sorry.
No worries.
Thank you.
So Jessica's responsible for leading BlackRock's sustainability and transition strategy. She will discuss trends we're seeing in transition investing and policy landscape. Can you actually advance to the next slide, which has the agenda? Thank you. Also here with me, Praveen Chari. Praveen is Global Client Lead for Aladdin Sustainability. So Praveen will provide an update on our climate analytics framework. We're also joined on Zoom, I believe, by my colleagues Jess Wang, Debarchi Basu, and Matt Ortizi. I'm going to turn it over to Jessica.
Thank you, everyone, for having us here today. And thank you for being such great partners for us. I'm delighted to be talking about a few trends that we're seeing in transition investing. And so first, the transition to a low carbon economy is one of the key forces that our clients are dealing with in terms of their portfolios and investment decisions. We see this as one of the mega forces changing companies, supply chains, and that's going to be affecting how we invest over the next couple of years. So it's our job as fiduciaries to study that trend, just like we would anything else, whether that's inflation or geopolitical risk, anything of that vein. And so when you talk about transition investing, we see three forces that are really powering the transition: technology, consumer preference, and policy. So I'm going to be speaking about each of these very briefly. And also, I think it's important to note that these three really reinforce each other. And eventually, once one picks up steam, it ends up being a little bit of a flywheel effect. So technology. So technology can see itself play out through a lot of different ways, right? It can, as technology advances, it lowers the cost of a lot of options that are out there. So the stat on this page is 85% reduction in solar costs over the past decade, which, you know, pause to think about is really huge. And the costs are really coming down quickly across other types of technology as well, including wind, battery storage, as a few examples. So in some of these cases, these newer renewable technologies are even cheaper than some incumbent solutions, and in some cases are very much cheaper. And so through time, then they replace incumbents. The second one here would be consumer preferences. So the stat we have on the page here is, you know, in 2021, we saw a 2x increase in global annual sales of electric vehicles. In China, sales tripled. So again, it's just something that is increasing the demand of this overall trend. You know, another thing for, you know, New York right here, I read recently in New York Magazine and New York Times, a huge uptick in induction stoves as an alternative to gas stoves, right? So even though that's hard to do in a place like New York City, consumers are still interested. The third piece here is policy. And this, has really been a huge force in driving capital into the overall transition investing space. So policy directly affects costs through subsidies and taxes, and also indirectly through regulatory standards. So climate policy, interestingly, in a lot of the developed markets, it's really intersecting with industrial policy. And so we've been able to see that through the Inflation Reduction Act in the US. There's also the CHIPS Act, the Jobs Act, that's just funneling close to 500 billion over the next couple of years into transition investing. And also in Europe, similarly, there's the Green Deal and Industrial Plan. And all of these serve to kind of push down the cost of a lot of these technologies. And again, these three factors really enforce each other. So, we've talked a lot about forces that are driving the transition. Of course, there could also be bottlenecks that we have to study. Permitting is a big one. Also, when did the policies potentially stop? Right? A lot of people say maybe at the end of the decade it slows or stops. So that's something that we really have to study as fiduciaries because that affects investment decisions. Obviously energy security, reliability was a big topic. Supply chains, overall trade protectionism. These are all things that intersect with this important topic. And so all things that we have to keep an eye on and how it relates to investing decisions and portfolios. So if we advance to the next slide. So given all of that, what are we hearing from clients? What are our clients interested in? And so what I would say is the transition to a low carbon economy is one of several major forces shaping portfolios and investing. And clients over the last 3 years, I think, have become a lot more sophisticated on what they actually want to do in this space. One, the data has become more standardized, more reliable, and there's been more regulation in place. So there are a lot of clients who really want to look at this data from a risk management perspective. We look at sustainable and transition information as we do all information. Some are really relevant for certain portfolio strategies, depending on time horizon, investment objective, asset class. And some might be less so, but that's up to investors to ultimately decide and work with our clients on.
Sorry, you say within sustainability, transition is the number one issues clients raise. Where does it fall sort of in a broader, like as you talk with clients, maybe minus like the right wing, but like or even then, like the conversation beyond a purely sustainable investing?
That's a great question. It depends on how you define client conversation. So for big long-term structural trends, I'd say we see 4 mega forces that clients are really interested in understanding. Transition investing is certainly one of them. The other one that we see is AI, digitalization, demographics, and geopolitical risks. So those are the big thematics that I think are long-term enduring in portfolios. And even within that, I'd say transition, I don't know, it's hard to rank, but it's probably near the top of that, depending on the client. And then other things that are more market specific, like inflation, it's hard to get away from that for sure. So I would say that's probably even more of a discussion than transition by itself, although the two are linked. So, but yeah, that's kind of what we hear. And so a lot of clients look at this from a risk management perspective. Others are really focused from an investment opportunity perspective. And the two are certainly not mutually exclusive. Some clients really want to use, these themes as a way to generate alpha. Some really think there's a broader secular trend, for tilts, and these are all very valid, investment strategies. The other thing is we have a lot of clients who are executing on commitments. So, right, they might have a net zero commitment at some place, as asset owners, and we want to work very closely with our clients to help them partner to get the best strategy that fits their individual needs. And so clients look at this in a lot of different ways. And again, the trend that we've seen over the last 3 years, our clients are getting more specific and more nuanced. There are certain clients who only want to invest in things that are green today, the highest bar and highest standard, and we work with clients in that. Others want to invest specifically in higher emitters today because they want to see their dollars at work or increase the impact in lowering emissions. Of course, it's not all blanket high emitters. It's those high emitters with the most credible transition strategies, the ones who might be priced at a certain level where there might be opportunities to put those dollars and actually measure the impact of those investments. It's hard to kind of categorize what we see from clients across the board. We try to do it up here regionally. Of course, there's a lot of nuance on this. In Europe, which might be the region with the greatest interest in this, at least uniformly, we do have a lot of asset owners who have specific net zero commitments by different degrees or different dates, I should say, different pathways that they want to follow. So that's something that we work with them closely on. In the Americas, and I'll come back to this, there are more divergent views. There are certain clients who want to integrate certain sustainability factors and really want to lean into it more, and other ones who want to minimize that. And to be honest, it's very much driven by individual client preferences and sometimes on a state-by-state level as well. So our role as a fiduciary is to work with clients across the spectrum, no matter if you want to lean in to the sustainability and transition factors and increase the weight of that in your portfolios, or whether you want to minimize that. Our goal is to provide that client choice. And within whatever mandates we work on with clients, our role as fiduciaries is to try to maximize the risk-adjusted returns and to be able to create the best choice and to try to maximize risk-adjusted returns. All of that has to be underpinned by very good research, data, and analytics. And that's where we and a lot of asset managers are focusing a lot of our time, because over the last couple of years, the data has gotten a lot better. Transparency has become a lot more uniform. And we've been able to get to that level where we can be more specific with clients about their individual investment needs. In terms of a regulatory perspective, I'll break it down into a few couple broad food groups. I would say the biggest thing that's making a difference in at least investment opportunity is probably the policy that we talked about earlier. The Inflation Reduction Act, the Green Industrial Plan in Europe, and there are other countries too who are following up with similar industrial policies, because that really does change the cost perspective. It changes how we underwrite deals. It changes how we look at the overall our portfolio construction, so on and so forth. The second thing on the regulatory horizon, and this is in a bunch of different regions, is regulators are trying to get more specific about anti-greenwashing regulation. And we think that's a good thing, right? So even something like the SEC names rule, which we're expecting guidance later on this year, very specific about what funds you can actually call sustainable, right? In Europe, there's similar regulations through SFDR in the EU and SDR in the UK. And so that's a trend that we expect to continue. It's a lot of work for organizations, but we're glad that there are standards. The third thing would be what I alluded to before. So it's kind of this very state specific in the US, regulation on trying to dictate where ESG factors are, where, what states want to lean into it a little bit more and which choose to minimize. And again, as a fiduciary, it's our job to provide choice across that entire spectrum. I think I've stuck with to the 5 minute.
Yes, thank you,
timer.
Jessica. Raveen, why don't you talk about our analytical framework?
Absolutely, and thanks, Jessica.
Can you advance to the next slide?
Yeah, if you can advance to the next slide, please. Thank you. So given the transition to the low carbon economy and to be able to enable investors to understand both the risks and the opportunities from the transition, we need to be able to conduct scenario analysis, given the range of possible outcomes that the transition can really lead to. And then that's really where the technology and the data and analytics really comes into bear, given the advancements in data and the quality that we are seeing increasing. So if you look at this slide and we start from the left to right, the framework really begins with the industry standard scenarios from recognized organizations, for example, the NGFS, or the Network for Greening the Financial System, which is essentially a group of central banks and supervisors that are promoting the climate risk management into the financial sector. And these are the scenarios that are largely used by organizations to look at the different forms of transition, whether it's an orderly transition to a net zero or say a disorderly transition to net zero. And there are other scenario providers, whether it's the IPCC scenarios, which is again another industry body that provides these scenarios. But the objective really much is to be able to quantify and help understand the transition risk, which is, as Jessica indicated, the changes and the risk profile and the opportunities that would be available from policy changes, technological advancements, as well as consumer preference changes as we transition to the low carbon economy. If you look in the middle section, once we have these scenarios, it is important to include sector-specific considerations as part of the transition models. And why that is important is companies, industries operating in different sectors are going to be impacted by transition differently, and that will enable the transition and their emission profile in the future. For example, in the automobile industry, we know what are the low carbon technologies available, but in many other industries, the technology evolution is still early, and we need to be able to incorporate that as we analyze
different investments and have insights that the investors can have. So it's important to bring that into the context of the data, right? Data in this particular space is evolving. The quality and all over the world, there is increasing availability of this data, and our goal is to incorporate as that becomes reliably available, that we can bring into our framework. It is also very important for investors to understand the model methodology, the assumptions about the data that is going into the model, and also limitations. This is a fast evolving space. You need to understand all those considerations before incorporating that into investment process. And that is the foundation of everything that we are doing from an Aladdin climate perspective. Again, as a fiduciary, we want to make those insights available to investors based on their considerations and how they want to integrate that based on their investment objectives. If you move to the next slide, please. And in the interest of time, I will focus on a couple of these areas which are important from a transition risk modeling, particularly as we look at corporates. There are segments of the market. We talk about sectors, and segmentation, which is the first box on the slide, is essentially how do we capture firm activities which are across different sub-industries and regions. You can imagine a conglomerate, or you can imagine a company with diverse set of business activities, and being able to understand and being able to address what those activities and how that will be impacted by the transition, both again to identify the risks and opportunities, is critical to be able to bring into the insights that the investors can have. And secondly, the demand impact. The transition is going to lead to demand drivers in different segments that are going to look different. There are going to be companies that are going to be in the transition linked sectors that are going to have a different demand driver. And there are going to be companies in non-transition linked sectors that can be impacted indirectly. How do we bring that into, again, the framework and provide that transparency on how a particular risk profile will evolve over time is critical in the transition risk modeling space. So let me kind of maybe stop there in the interest of time and hand it back to Jeremy, but happy to take questions.
Any other questions for us?
So Dave Kazansky, I have a question just generally about, so when we were discussing our net zero implementation plan, one of the things that I've been reading about recently is a lot of banks removing themselves from the Net Zero Banking Alliance. And I just wanted to get your idea of what that means for companies and banks and general push towards net zero, whether that hampers anything.
I think that's a good question. So I think some of the recent levers that I've seen have been in the insurance sector. So leaving the NZIA, I believe. And from what I understand, I mean, I don't know, they wanted to, do net zero their own way. It's not that they're any less committed, but they thought being a part of an organization was less helpful to them at this stage of achieving their net zero commitments. From our perspective, we made the decision to join certain organizations to be a part of the conversation. And, we regularly evaluate, all memberships. And I think that each individual organization now has to figure out, where they are in their own commitments to themselves and their clients, and whether, being a part of an alliance is helpful or not. But from what I understand of those organizations, and of course not a part of any of those insurance ones, that doesn't mean they're any less committed to the overall goal.
Thanks.
Other questions?
Thank you.
Thank you. Thank you. Any questions, I guess? Thanks, Jeremy, Jessica, Praveen. Thanks, Jess and Devaki on the Zoom. Appreciate it.
Thank you very much. I appreciate the partnership.
Great. Okay. So. Guess we need a motion to go back into. Executive session. So move John Dorsey on behalf of the controls office. Thank you, John Dorsey on behalf of the controls office. Do I hear a second? Thank you. Victoria. All those in favor of going back into executive session, please say aye. Aye. Those opposed say nay.
I, Angela Green.
Thank you, Dr. Green. Any abstentions? Great, and we're back into public. Okay, and I believe there will be a attorney-client.
We good to go?
Yeah, we're, okay,
Can we take like a bathroom?
Sure.
together, food break?
sure.
Hi, this is Ron Swingle, an executive session of the variable funds. We received a presentation from an international equity manager. Consensus was reached. We provided a list of manager contracts that are up for renewal. Consensus was reached. An executive session of pension fund. We received preliminary performance data. We received a private equity presentation and a real estate presentation. Consensus was reached on both.
Great, thank you, Ron. I think that brings us to the end. We will have a attorney-client session, but I think we're gonna break for lunch and maybe we can have the attorney-client session while we're having lunch. Okay, so do I hear a motion to adjourn? So moved. I hear a second.
Second.
Any abstentions? Well. Did I say all those in favor say aye? I said that. No, I didn't say that.
I didn't say that.
All right, cool.
But I think you know how that vote's gonna turn out.
So let's do it from the beginning. All those in favor of adjourning this meeting, please say aye.
Aye.
All those in favor and opposed say nay. Any abstentions? We're adjourned. Thank you, everybody.